You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have the Investor Way Fantasy Portfolio Special for 2025. Sam, do you want to run us through the performance of the portfolio over the last year?
Yes. So firstly, we have Bitcoin. So when we first set up the portfolio, I should say it was a £1 million portfolio 5 years ago now. So we've hit the 5-year mark. We did a 2.5% allocation to Bitcoin, which was 25,000. That was down 15.3% for the year. However, overall, it's still up 233%. So the Bitcoin's now worth 83,000. I wouldn't propose making any changes to the Bitcoin. We didn't last year when it was higher, so I don't see why we would now. So I'm assuming I could just run on to the next one.
Yes.
Next, we have Bloomberg Commodity Index. So again, I think we were kind of aiming for around 20% commodities. That included the Bitcoin. We took the view of that was going to be like a digital gold. I think the initial allocation was 2.5% Bitcoin, 17.5% Bloomberg Commodity Index. That has done fairly well. That's up 10.26% for the year, and that's now up 67.6% overall. So that's now worth £201,000, and it has a cost of £120,000 because I think we trimmed it a few years ago when it was doing really well. So let's just check the weighting of that. So the Bitcoin plus the commodities, they're worth 19.13%. Wouldn't propose making any changes to that. I'm quite happy with that overall allocation. Frustratingly, I don't think the commodities index actually includes silver and gold. I think it seems to include everything else.
I was going to say, because in my own portfolio, and I think it was largely influenced by How to Own the World by Andrew Craig, having that allocation or a similar percentage allocation in commodities, and also, within that, particularly gold, and that's done well in my own portfolio. I'm not sure. I'll have to go back to our original fantasy portfolio and see whether we have the discussion about having silver or gold, but particularly gold in there. Because now that you look at it at whatever $4,500 an ounce, you do wonder. But anyway,
I don't think it was deliberate. I think we just kind of thought we were covered with the Bitcoin and the commodity index. And unfortunately, we've missed them out. But there's no point adding them now.
Oh, well, all-time highs, but you never know. Let's move on.
Well, I've not put them on the list to suggest buying.
No, fine.
So next up, we are onto the index funds. So we had 20% commodities, and we had 40% index funds, and then the final 40% was stocks that we were actually picking to try and limit the impact of our own incompetence. So the index funds, we had 5 of them, and we just put 80 grand into each one. So first up, we have Developed Asia Pacific Index Fund. That is up 25% for the year, and that's now up 11% overall. So that's now worth 88,000. I'll just say as a blanket statement, wouldn't propose making any changes to the index funds. I think they're doing their job pretty well.
Yeah.
Next up, we have the Developed Europe Excluding UK Index Fund. That's up 26%, and that's now up 62% overall. Probably worth mentioning, we didn't include UK in the index fund on the basis that a lot of the picks we were going to be making would be UK listed stocks. So we felt like that would be well represented in the individual shares part of the portfolio. Next up, we had the S&P 500 index fund. That's up 17.46%, and that's now up 98.71% overall. Then we had Japan Index Fund. That's up 17.45%, and that's now up 40.36% overall. Then we had the Emerging Markets Index Fund. That's up 21.7%, and that's now up nearly 30% overall. So the index funds, they're all up. The lowest one is up 17%. So they've all had an absolutely cracking year.
Coming on to the rest of the portfolio with the individual picks.
Unfortunately, they've not all done at least 17%. So to match the index funds, you can tell the way it's heading already, but we're up against it. We're now onto the individual part of the portfolio. So that's the final 40% of the portfolio. First up, we've got Associated British Foods. That was originally added in 2021, so it must have been after 1 year, but we then topped it up last year. So that's up 3.38% for the year, and that's now up 5% overall. I wouldn't propose any changes with that. I think it's plugging away nicely. I think Primark's doing well overseas. Yeah, I'd be quite happy to just keep that as it is. I wouldn't feel the need to top it up again or to trim it. What about you, John?
Yeah, no, I would agree. And I think it's a fair valuation. And also, you've got the cyclicality of the sugar business. And it feels like we're at the bottom of a cycle with that. So, yeah, I'd be quite happy to hold that. I don't think the investment thesis has changed with it at all.
Okay, next up, we've got Airtel Africa, probably at this point the favourite of the show. That was a double allocation. That was originally added in 2021, and it must have been topped up at some point to take it to a double allocation. So that has had a very good year. So it's the FTSE's second best performer. So it's up 196.64%. And that it was nearly £44,000 allocation. That's now worth over 120,000. And that's now making up 8% of the portfolio. Obviously, it's a fantastic year for Airtel Africa. It's one we both hold personally. For me personally, I'm not selling any of it yet. I'm waiting until Airtel money's being split out. However, the issue we have with this is we don't get a chance to wait and see what the valuations are when they've been split up. We have to wait till next year. So I would suggest, given that we're at an 8% allocation, I would suggest trimming that. And the figure I'd sort of thought was if it's worth 120,642, I would suggest trimming it down to 100,000. So that would sort of take it down to around sort of a 6% position instead of 8. So we still have a very good allocation to it. And then that can be used to potentially fund some of the purchases that we've suggested later on. What do you think, John?
Oh, it's a difficult one because, as you say, we both own it, and in my own portfolio, I'm hanging on, and I'd be very interested to see what happens with the spin out of Airtel Money, and I'm not taking any profits with it at the moment. So I'd be inclined to follow the same with the fantasy portfolio, but I suppose 20,000 on a total holding of 120 is not a huge amount. So I'm not entirely opposed if you're keen to invest it in something else, which obviously we can come on to that list later.
What we can do, we can leave it on for discussion.
Yeah.
And we can see how much we want to buy at the end.
Yeah.
If we don't need to sell anything, we can just leave it as it is.
Yeah. There are some exciting businesses on the list for discussion, so we'll come to that.
Okay, next up, we've got British American Tobacco. That was a single allocation. That's up 45.7% for the year, and that's now up 81% overall. In addition, we've had dividends of about $2,000 from it. I think we've seen a bit of a valuation re-rating, and I would just take the money and run on this one. I think it's now at a yield of 5.7% compared to kind of 9% when we bought it. We're up 81%, which, considering we only bought it at the end of 2023, it's far more than I think we have any right to expect from a tobacco company over 2 years. I think the money could now be better used, and potentially, if that valuation changes, we could maybe re-enter at some point. But I feel like it's done its job pretty well. So I'd suggest selling British American Tobacco.
Fine. Let's do that.
Right. Okay. Well, at least we've now got some money to reinvest. So that's good. That'll be 36,000 that's been raised. So next up, we have Diageo.
Oh.
Possibly the most... Well, actually, no. That spot's reserved for Disney, the most frustrating stock in the portfolio. So Diageo, that's been in since we started the portfolio.
Oh.
It's been topped up to a double allocation, and then it's been topped up again. So it's actually had an allocation of basically 2.5. The most recent top up was last year.
Oh.
We thought it was pretty cheap. It was about £25 a share.
Oh, no, Sam. Painful.
In case anyone's not followed Diageo, you can tell how it's done by John's noises, but that's down 37% for the year. We have had dividends of 4.98%, but overall that's down 43%. For me, it wouldn't feel like we're throwing good money after bad with Diageo. I would actually put it on the list to suggest topping up a third time, because I really do think at some point it has to, at some point the quality of these brands has to shine through.
Yeah.
I'm not concerned about, this isn't going to be a boohoo. I think there's a flaw as to how low this can actually go with those quality brands. And I feel like we must be at that floor now. We might be here in a year's time, but I'd like to put it on the list to discuss topping up for a third time.
Okay, I think it's a very, very bad habit. We'll discuss it, but that's the problem. I think it's the habit rather than anything else. In my own portfolio, I still hold it, and I do still believe in the original thesis with it. But it's that sort of the behaviours, and I suppose, selling your winners and watering the weeds. It's that kind of thing. Let's come on to discuss it. We'll see what else we have on the list later.
Right. Okay. So we've done the spirits. Now we'll have some mixer. We've got Fever Tree next. So that was a new addition last year. It was only a half allocation. We only put 10 grand in. That's up nearly 21%. I'd just leave that as it is. I think last year the valuation was quite attractive. I think it was a bit more compelling. I think it's still pretty cheap now, but I think when we look at the list of ones we've got to discuss later on potentially buying, I don't feel that valuation is quite as compelling in comparison as it was to a year ago. So though I still like it, I've bought it personally and I'm holding it. I think in terms of the opportunity cost, I'd just leave it where it is. I wouldn't top it up again, even though it's a half allocation. What do you think, John?
Yeah, I would be happy just to leave that where it is.
Okay, that's easy. Next up, we have Games Workshop. So this is another favourite of the show, I think. It's one that I own personally, and John's unfortunately never got around to buying. So that's had a very good year as well. That's up 43.5%. We've also had a dividend of just over 2%. That's now up 104.3%, and we originally bought that in 2021. And that's now worth 4.44% of the portfolio. I'm pretty happy with that allocation. I think at 4.44, I'm not really concerned about the size or anything like that. I think when we've covered it, there's still a lot of opportunity for expansion. Overseas is bombing away. You've got the licensing. I think it's still got quite a lot of runway. So I'd propose leaving Games Workshop as it is.
Agree. Quality company. And I think we just let that run.
Perfect. Next, we've got LVMH. LVMH, we originally bought that in 2023. Well, at the end of 2023. Well, that's down 0.5% for the year, and we're now down about 6% overall. We've already topped that up once, so that's now a position and a half. I think the valuation's pretty reasonable on it. Some really high quality brands. However, I think it's already a pretty reasonable allocation, so it's 2% of the portfolio. I think you could make a good argument for topping it up again, but I think it falls into the Fever Tree category in that we've got some more compelling businesses, so I'd just leave it untouched.
Yes, I would leave it untouched as well.
Next, we have a new addition. So we've got the Magnum Ice Cream Company. So this has been spun out from Unilever. So because we hold Unilever in the portfolio, we've now got 1 share of Magnum for every 5 shares of Unilever. That's worth £1,700. So it's worth 0.11% of the portfolio. I think we've been fairly vocal in terms of we don't really like the idea of splitting out the ice cream from Unilever. No, appreciate it's lower margin, but I think some really quality brands in there. Unfortunately, it's been spun out at a value where it's just tiny. It's not going to make much difference to the portfolio, but since it's been spun out, we haven't covered it on the show. We've not had any chance to look at the valuation. I don't feel like we can really make a decision either way on that. So I think just leave it, even though it's not going to make any difference to performance. And then next year we can make more of a decision of, do we want to hold it, or do we want to add to it, or do we want to get rid of it? So I'd just leave that until we've actually had a look at it.
Sounds very sensible.
All right. Next up, we've got Money Group. So that's Money Supermarket. That's been in since inception. That is down 4% for the year, and that's now down nearly 20% overall. And that's yielding nearly 7%. It looks like it's been topped up already because it's got a position and a half. It's about 30 grand cost. I would propose leaving that. I feel like it's a stock that's maybe been a bit hard done by in that the business performance I'm pretty happy with in that time period. I think especially the way it's dealt with kind of COVID, the energy business switching off. Unfortunately, the multiple's just been compressed. But at that yield, well diversified, quality business, I'm quite happy just holding it and taking the dividends. What about you, John?
Yeah, no, I tend to agree with you. It's always been your baby there, I think, with Money Supermarket. Out of interest, what has the multiple now been compressed to?
Let's see. So it's now at a PE of 11.
Oh, wow.
I mean, it's been as high as kind of 17, 18. I think when we put it in, it was kind of around 13, 14. That's the figure I've got in my head. PE of 11, dividend yield of 6.82%. So.
Yeah.
I mean, if it wasn't for the fact that it's already a decent allocation, I think you could make an argument for topping it up. But when it's a position and a half, I think just take the dividends.
Yeah, absolutely.
Next up, we've got Rightmove. So this has not had a good year at all. So this is down 21%, and that's now down 13% overall. The yield's just under 2% on it. That's already been topped up once. So that's a position and a half as well. PE now under 20, I think, for the first time since we started covering it. So you've wanted to put that on the list for topping up.
I have, yeah.
I think that's a discussion that's well worth having. So I'm quite happy to have that.
It's a shame, actually, we haven't covered that properly since the big investment or that £1 billion that they'd allocated for AI investment. And I think that was
on at some point next year.
Well, no, it will be. But I think that is something, because the share price after that failed bid for the group was performing very well.
Yeah, it was, yeah.
And then that's what really seems to have turned the market, or investor sentiment against it.
Okay, so next up, we've got Supreme. So this has been in the portfolio for 3 years. However, last year, we basically cut the position in half. So at this point last year, so Supreme, I think, again, probably not quite a favourite of the show, but it's a company we've covered a lot and I own. That's been in since 2022. As of last year, it was up 74%. And I think we had a vaping ban coming up that we weren't sure what the effect would be. So we trimmed that and basically cut it in half. Since then, it's actually down about 18%. However, in terms of the business performance, I think it's had a really good year. I think the vaping ban's not really made any difference. On top of that, I think it's doing a much better job now. It was already doing a very good job, but it's doing much, much better at moving away from those vaping products. And it's now adding other brands to sort of, in the last year, it's acquired Slim Fast. What was the other acquisition?
Typhoon Tea.
And it's acquiring these well-known brands and it's bringing the production into the Manchester facility that they've got, cutting all the overheads and just producing it in Manchester. And as long as they get a business with decent gross profit, even if it's been loss-making for a while, they can usually get some good operating profits out of it. So really, really good operator. Really, really like the acquisition strategy. A lot of these acquisitions is a payback period of 2 or 3 years. Some of them are just ridiculous. So yeah, for me, I would actually suggest, especially with the fact the share price has come down and I think the business has got better, I would like to put it on the list to discuss.
Yeah, very happy
topping that back up.
Very happy to discuss that. And I think it's interesting that it is pursuing that wider kind of consumer goods.
Yeah. Okay, right, that's on the list. Next up, we've got Supermarket Income REIT. This was a new addition last year, and that's up 17% and now yielding about 7.5%. Very happy with it. Can't really complain. I'd suggest just leaving it as it is.
Yeah, I would agree with that. I like it. It's a business I own.
Yeah, me too as well, I should say. Next up, we've got Taylor Wimpey. So that's been in since inception. Unfortunately, it's not done overly well. We have had some good dividends from it, but in terms of the performance, it's down 13.5% for the year, and that's down 24.2% overall. It is yielding nearly 9%, and I think you want to pop it. And it looks like it's actually been topped up once already because it's a 30 grand cost.
Yeah.
So I think you'd like to discuss topping it up again.
I was thinking of that. I appreciate now looking at it being a double allocation.
Well, it's 1.5.
A 1.5. We'll have a think about it. We'll see what else is on our list.
Next up, we've got Unilever. That's also been in since inception. That's down nearly 1% for the year.
Yeah.
And that is down. Oh, that's up 18% overall. Okay. And it's yielding 3.6%. Obviously, as well as that, we do actually have a little bit more in terms of that 0.11% from Magnum that we covered earlier. I think Unilever's been a frustrating business. I think I've not always agreed with the strategy they're pursuing, but I would suggest leaving it as it is.
Yeah.
Assuming you're in agreement, especially with a new CEO.
Yeah.
He's been in the job a year now.
Yeah, well, exactly. I think with Fernando Fernandez, and on good authority from Terry Smith, he is a slick operator. So let's see, I think, probably what the next 18 months bring, and then judge it on that. If we weren't seeing any meaningful improvements in performance and the overall strategy, then I think it would be up for discussion whether it's kept beyond that.
Next up, we have YouGov. So that was a new addition last year. It was only a half allocation. I also bought it personally. It was very much a turnaround story. It's down 38.5%. It hasn't turned around. I don't think it's showing much signs of life. I've since sold it personally. I'd suggest just cutting our losses and getting rid of this. I think we've got better uses for the money, and I just don't really have that conviction I had a year ago. I think with other turnarounds we've held as well, with like Boohoo and stuff, I think, we can give it another year or two, but based on what usually happens, I think if it's not showing signs of life now, I don't know when it will.
That's fine. So we might be lucky to leave with what we have. Okay.
Yeah, we'll come in next year and it'll be the FTSE's best performer or something like that. But that's life. Right, so that's all the UK stocks. With the rest of them are US listed.
Yeah.
So first up, we've got Fiverr.
Yeah.
So that's been in since end of 2021. That's a position and a half, and that's unfortunately down 65%. It's down 38% this year, though. Again, so that's now worth 10 grand. I would actually suggest getting rid of that one. I think we've given it 4 years. It's really a frustrating business because I think in terms of the market it's in, it's a market with a lot of long-term tailwinds. However, we've also got Upwork in there now. And I think consistently over the 4 years that Fiverr's been in there, and even the whole time we covered it on the show, I think Upwork's been the better operator for the most part. I think it's the bigger business as well. I just think we're holding both of them. I get it's kind of a play on the industry, but I think we've given it 4 years and it's not performing. So I'd be tempted to just take the money and reinvest it somewhere else.
Yeah, and it's something I've reflected on because I did buy Fiverr and Upwork at the same time, which has actually been over the last year. So the performance has been a bit different for both of them. But I think one of the things with Fiverr is that AI has disrupted that end of the market quite a lot. So I think the projects on Fiverr, I mean, it's kind of says it in the name, but they're generally smaller and they often be kind of graphic type jobs. And I wonder now with AI coming in, how much that is disrupting that end of the market. Because if you can have ChatGPT or whatever other AI doing those kind of low end jobs, how much is left for Fiverr in that market? I think Upwork tends to be bigger projects. I don't know whether you would agree with that as someone who's actually used the product yourself in the past, Sam.
Based on my own experience. But it's like, for example, Fiverr, I used that to design the logo for this podcast. Yeah. If I was doing it now, I'd probably plug it into AI. I'd say it's an investing podcast. Yeah. It's UK focus, suggest some ideas for a logo. Yeah. And probably would just take it, especially when we're not monetizing or anything like that.
Yeah.
Whereas some of the stuff on like Upwork and stuff, it's like, I mean, we're going back sort of 15 years now, but like when I was a teenager, I used to write articles about like the Premier League on there. And that's still the kind of thing now where if you're writing for a blog or something, I don't think AI is quite at the level where you can use it to like generate that kind, especially when it's live stuff.
Yes.
Immediately after. It's not quite there yet. If you wanted to spit out an article for you on something, it absolutely could. But a lot of the, like my dad would use it a lot and he'd have sort of people in India that he was using almost as like extra employees, really. You can see a lot where it's like if you want an accountant in India, you can go and get one Upwork. And it's those kind of, it's almost like an extra member of staff, really, rather than just, like you say, a one-off, more designy job.
Yeah.
I'd agree with that. I think the thesis has unfortunately probably changed in the last year in a way that we just couldn't have anticipated as well.
No, absolutely. So
I think even before that, I think Upwork was performing better. I think it's a better operator. But yeah, so if you're happy with that, I'd just sell it and take our 10 grand and
yes, happy to do
how
that.
We're going to try and find a 3x to get back to where we started.
Well, let's keep our heads and we'll discuss what's on the potential buy list.
Next up, we've got Etsy. Again, this is one of mine. I've had it since inception. It's been in since inception, so 5 years. Not performed, down 60%. It's actually up 6% for the last year, so it's done a bit better. It's worth 10.5 grand. So this is something that personally I've been weighing up a lot now, because I do feel like my judgment is clouded by the fact that as a user, I think it's a fantastic product, and I think it's a unique website. It's great for gifts. I really, really like Etsy, but unfortunately, most of the metrics are now heading in the wrong direction. Users, buyers, sellers, they're kind of all dropping now. They are getting more and more revenue out of those users that are remaining. However, this is not a tobacco business, and that is not something they can do indefinitely. So it is something that I'm unfortunately having to weigh up myself personally. And I think at some point I'm going to have to make a decision of, do I just ditch Etsy? I think in this portfolio, I think especially when you've never really had that conviction anyway.
Yeah.
I don't think I can justify keeping it in there, because I don't. It's had 5 years, and I think it's not performed. And I think the metrics are actually now worse than they probably were 5 years ago. It's not like, for example, when we talk about Money Supermarket, it's had a rough 5 years, but actually the business has done well in those 5 years, and the valuation's been this business has performed poorly. So I think I don't think I can justify keeping it in there now.
No, I think that's I would be in agreement with that. As someone who's probably a light user of Etsy, I do wonder whether some of the Chinese competitors, whether that's influencing things. I don't know. With the experience with Boohoo, I appreciate they are different businesses, but I think that does stick in your mind that we were seeing things. Well, they were initially going in the right direction with Boohoo. Share price was going in the wrong direction, and you thought, well, why is the market thinking like this? And obviously, we thought we were right on that. And actually, what we hadn't appreciated was the growth in Temu and Shein. And I do wonder whether there's something along those lines going on with Etsy that I, as someone who doesn't use it very much, I'm not aware of. So yeah, I do lack the conviction with it, and I would be worried about the direction that it is going in and what else is at play there.
Yeah, I mean, I still think in terms of Shein and Temu, it's like at the lower end of the market where it's just tat that you'd get in like a stall or something. I can see the point for that. But then for a lot of, it's like, for Christmas, one of my presents was like, it's a collection of bullets from the American Civil War.
Yeah.
And someone's gone around the battlefields with like the permission of the landowners. Landowners have had to dig up the bullets. They've put them on a little display thing with a bit of information about, how many fought on each side, number of casualties. That's not the kind of thing you'd be able to get from China. Maybe a fake version, but yeah, and it's stuff like that. So I think it's sort of, once you get into that sort of £20-30 plus, the unique gifts, those kind of ideas, there's a lot of stuff you can just only get on Etsy.
Yeah,
that lower end of the market. Yeah, I think that's an issue, and I don't know how much of Etsy sales that makes up.
No.
So yeah, I do take a point. Next up, it's probably another one of mine. PayPal. That's been in 3 years now. PayPal is down 30% for the year, and that's now down 25% overall. And that was just a normal allocation of 20,000. So I think with PayPal, I'd actually propose hanging on to it. I think we're still covering it on the show, and the business is plugging along. That valuation's continuing to get compressed. I mean, in fairness, it's actually up and down a lot, really, but the valuation seems to have been compressed even more. But I'm actually quite happy with the business performance. I own this one personally. I stand by my thesis that it's going to get a re-rating, and I don't feel like the business performance actually justifies getting rid of it. What about you?
Fine. It's not one that I would be buying personally, but the fundamentals haven't dropped off with it. There has been a compression in the valuation. We can see what happens with it.
Okay. Upwork, that was a new addition last year. If we'd bought it instead of Fiverr originally, we were doing a lot better. But anyway, that was up 23% last year. We did about 3/4 of an allocation of that, so that's now worth 18 grand. I really like Upwork still, but I think we've got better areas to invest the money this year, so I think just leave it as it is.
Agreed.
Next, we are now on to the most frustrating company in the portfolios. It's Walt Disney. It's been in since inception. One of the favourites of the show. We both own it personally. I think we've both been very patient with it. It's up 1.8% for the year. And it's now down 20% overall, and we're getting a dividend of 1.3% on it. This has, I think it originally went in at a double allocation, and since then it's been topped up. So I think it's 2.5. So it's got a cost of 56,000. So it's actually our highest cost basis of all the individual stocks, which probably maybe adds weight to your argument about not topping up Diageo based on our track record. So I think we both continue to hold it personally. It's a really frustrating business because I think that potential is there in terms of the IP. And you look at what Netflix is doing, and I don't see why they can't be doing sort of something similar with some of the best IP in the world. Now, you've got the Netflix deal with, is it Paramount or who's it? Who they buy? Warner Brothers, that's it.
Warner Brothers.
Netflix
So Paramount were...
Yeah, so you've got Netflix and Warner Brothers. If that goes through, I think that's a big problem. But I think just in terms of the performance, I think it's not really got going, unfortunately. And although that potential's still there, we've got quite a lot of money tied up in it. I would propose dropping that. I'd propose cutting it in half so that it's just back down to kind of a normal allocation, because I don't feel like my conviction's as high as it was 5 years ago. I don't think the business has performed. And I think, although I don't want to get rid of it completely, I think the cash can be better used at this point until it starts to deliver.
Yeah, I think we can have a discussion about it. For me, it would either be whether we just leave it, not add to it anymore, whether we actually sold some of it. I mean, maybe we just see when we go through the buy list, what's on there and how much cash with the ones that we are selling we've got, and we can have a think about it, whether it would be better used in some of those other companies that we've got on the potential buy list, which we'll come on to in a few minutes.
Okay. And final company we've got is Wix. So it's the US website builder. This was added 2 years ago, and it's quite a small allocation. It only got 10,000. That's had a terrible year. That's down 52%. Although overall, it's only down 15%. It's quite a volatile stock. I think, we're talking about a 10 grand allocation that's down to 8.5, and it's only had 2 years. I'd just leave that. I don't think it's worth doing anything with either way.
Agree.
Right. Okay. So in terms of performance then, we've also had £20,000 of dividends, I should mention. So we are up for the year 13.68%. I think a pretty good year. And my thinking was, just to remind everyone, at the end of last year, we were down 8.3% compared to our benchmark, which was the world index. So I really felt like this could be the year where we've caught it up.
Yeah.
Unfortunately, the world index continues to outperform us. So we were up 13.68. The world index was actually up 20.64%. So we've worsened by 7%.
Yeah.
Overall, we're now up 49% in 5 years, which I don't think is terrible.
No.
But the world index is up 68%. So we're lagging by 19% now. So is what it is. I would, in our defense, I would mention that I think, firstly, this portfolio, despite some of the stocks in it being really bad, it's not been that volatile. So I think a lot of the portfolio has kind of done its job in terms of the commodities, the index funds, and that quite low allocation to individual stocks. So I think in terms of the volatility, it's performed very well. At no point have we covered it and we've actually been down. I appreciate that's actually helped by the starting point quite significantly. But when the world index is so much US and our US weighting is a lot lower because of the way we've done the index funds, we would have to absolutely batter the US market with our individual picks to actually outperform. And that's not an excuse, because I think we have still underperformed. But I think unless we'd made taken a much more bullish position about the US weighting from the beginning, we kind of never stood a chance, would be my argument. And it could all change, but I'm still quite happy with the makeup of this portfolio. It's not 70-80% US weighted, and that does give me a lot of comfort going forward. Do you have any thoughts on that, John, before we move on?
Yeah, I mean, I think fundamentally, if you do look at the all-world index, it's really heavily weighted towards the US, and then you've got the Magnificent Seven within that, and they have had a really good year. So I think it's an incredibly difficult challenge to beat that. I think in my own portfolio, yes, I have some individual stocks, but the largest allocation is All World Index, because I think it is so difficult to beat that. And you've got your examples with Airtel Africa, but they are few and far between. And I think you have to have a lot more of those if you're going to disrupt and beat the market. And it's also the being able to do that consistently, which is incredibly, incredibly difficult. And I think if you do look back historically at the really successful investors, the household names, your Warren Buffetts, there are probably a handful in the last 100 years that have been able to do it consistently. So it's no mean feat to be able to do that. I think one of the things, reflecting on it all, is that we do get enjoyment from it, from consistently underperforming, but actually doing a bit of stock picking. It can in itself be fun and be a pastime. So I think there is that to say about it too.
I think as well, actually, I didn't work it out. I think if I went through year to year and actually worked out how the individual part of the portfolio had performed, I suspect we might be doing even worse.
Yes.
So although we're not blowing our own trumpets too much here, I think the fact that we kind of acknowledged that from the beginning and just had a 40% allocation for individual stocks, it has actually made the performance look a lot more flattering. I think 49% compared to 68% for the index, it's not great, but it's also not terrible. Because I think with some of the stinkers we've had over the last 5 years, we could have easily been down if we'd been picking ourselves.
Yeah, but I mean, I think it's, it makes you reflect on some of those really sort of those veteran investors. Like, for example, in the UK, we've been to Fundsmith quite a few times now, but quite how well Terry Smith has, or how incredible his ability as a stock picker actually is. Because I think he would have been going now with Fundsmith for about 15 years, and to still be ahead of the index, even if it's not by a huge amount over that time. And it's not like he's been sort of index hugging. That has been individual picks, is pretty incredible. And that excludes exposure. Well, I say he has some exposure to AI, but he doesn't have NVIDIA in that portfolio.
Yeah, he's not just picking hot stocks.
Yeah.
And just riding a bull market.
Yeah. One other point to reflect on is I was influenced a lot by A Random Walk Down Wall Street by Burton Malkiel. And that is kind of case in point in the thesis, one of the big books, if you're looking at sort of passive investing and essentially just owning the index because it's so difficult to beat the market. And I suppose Bogle's book as well, Common Sense Investing. Obviously, he's died in the last few years, but was a founder of Vanguard. I think you read those books and you do sort of think, well, maybe I should just be owning the index. I guess one counterpoint on that is that in the last few years, with more people following that strategy, you do have now over 50% of of the market just being owned passively. And you do wonder what that does to the market overall in terms of efficiency and lots of other things. And at some point, whether the fundamentals are actually driving the market overall and how much of it is being pumped up, regardless by that strategy being followed. I think that is, a concern longer term.
Doesn't seem to be pumping any of my picks up.
Well, no, fair enough.
I think as well, one thing that's been really interesting is, I think when I've been going through my portfolio, because you are just psychologically, it's difficult to criticize your own ideas.
Yeah.
I think it's easy to look back to look forward year to year. If you take Etsy as an example and say, well, actually, no, I still like this product. These things, if they can just do this and you give it another year, and on a 1 year basis, you can kind of make an argument for continuing to hold some of these businesses. But then you look at some of them and it's like, if you told me 5 years ago that Disney would have been down 20% over that period, when I already felt like it was quite cheap.
Yeah.
And you told me that Bob Iger would have come back in that period, I wouldn't have believed you. You look at Diageo and you get some of Diageo is probably not as good as an example, but Unilever, for example, you've been waiting 5 years for this turnaround to happen. We've had 3 CEOs or whatever in that time. And you're now talking about it as if it might happen under the next guy. But it's like, I think when you actually look at it for 5 years, it's like, well, actually, I guess you can be much more critical of the performance then. Whereas on a 1 year basis, you can it's easier to kind of deceive yourself with it. Whereas I think now we're at the 5 year mark, there's quite a few businesses where it's like, I mean, like Etsy's a good example. Like I've kind of stuck with that for years, and the years have kind of crept by, and then you don't realize how long you've been giving it the benefit of the doubt for until you look at something like this. So
yeah.
And
there is the watering the weeds sort of argument. And I'm not saying that necessarily applies to Diageo, but you do, when you look down our list and when we've given double allocations, or we've said, it's the market has given it a hard time. We actually think the valuation is much cheaper, and there's a more of a value opportunity there. And then you top up and you top up and you top up, and you don't. It fundamentally isn't ever going in the right direction.
Yeah, right. So I think that's everything in terms of our performance or lack thereof for the year. Should we move on to just to recap then in terms of the sells? We've proposed selling. Well, we've got on the list to discuss Airtel Africa, British American Tobacco, YouGov, Fiverr, Etsy, and Disney. So I think British American Tobacco, quite happy that's gone.
Yeah.
YouGov and Fiverr and Etsy as well. I think you're happy to get rid of those as well.
Yeah.
Okay. So if we sell those and nothing else, that's given us 63,000. However, as well as that, we would have dividends of 20,000.
Okay, that's nice.
Absolutely. Well, it's all those REITs we've added. I say those REITs, not one. No, we've got some high dividend payers. Although it'll drop with British American out now. So that's about $2,000 of dividends gone.
Yeah.
But that takes us up to 83,000. So we've got a decent amount to play with, actually. That would be for what would have been full allocations originally. Although the portfolio is now 1.5 million rather than 1. But we'll still treat 20 grand as a full allocation. So do you want to run through the list of your proposed purchases, John?
Okay, so Novo Nordisk, that's up there. It's one that I added to my own portfolio, and I think you did as well earlier in the year. We had covered it on the show before. I think after we'd both been to Fundsmith, we got a bit more of an appreciation of the business from Terry Smith, because it's one of their larger allocations in the portfolio. It's the Danish diabetes pharmaceutical business, but with a focus on diabetes. It had the core diabetes medications, and it recently, well, I say recently, in the last few years, was one of the companies that came up with a couple of hits in the new category of GLP-1 inhibitors. So they're commonly sort of thought of as the kind of Ozempics, which is actually a Novo Nordisk brand, Wegovy, and there's Mounjaro as well, which isn't actually one of theirs, but those kind of weight loss, in inverted commas, injections. So that was developed originally with a view to diabetes, and then obviously when it was realised what an impact it had on weight, became more popularised, and they had it licensed in the form of Wegovy for weight loss specifically. And you did see a massive rally in the shares on the back of that, I think primarily sort of 2022, 2023. And that has really come back down to earth over the last year or so. And the valuation has been massively compressed. I think that's largely due to Eli Lilly, and that Mounjaro has sort of essentially come out and is more effective from a weight loss perspective. So there's been, from not having much competition in that market to potentially having a better drug available for a competitor, that's really brought Novo Nordisk back down to earth. I think the investment case, though, is that it was a very high quality diabetes pharmaceutical company with a focus on diabetes pre GLP-1 inhibitors, so pre-Ozempic, pre-Wegovy, and that actually that's being a bit lost in the hype and the sort of run up with those new drugs coming out, that sent it to a metric that it had never seen before. And actually, the fundamental diabetes business hasn't disappeared, although with Wegovy and Ozempic, who knows what the future for them is. But that fundamental business is still there. And, even if it doesn't have the market share that it once did with Wegovy and Ozempic, that it can still do very well. And that's probably being a bit cautious and a bit bearish, suggesting that it doesn't have a future in the GLP-1 market, which seems, to me, pessimistic. At the moment, I think I'll have to double check this. It's about 15 times earnings, which for a business with the growth potential, I would argue, does seem quite cheap. So it's one that I would propose adding. I did buy it probably six months ago or so, maybe a bit longer, and I'm quite happy holding. The other thing with it is that it's got a reasonable dividend between 3.5% and 4% now. So I quite like this business, and I would propose that we add that to the fantasy portfolio. What are your thoughts, Sam?
Pretty much identical, really. Obviously, we've covered it multiple times throughout the year. During the year, we've both purchased it personally, and obviously, there's all the arguments you've made. Terry Smith makes a very good argument for it as well, and it's part of the reason he sold Diageo. We're obviously hedging our bets and having both, but I think as well that they just had the oral one, hadn't they, approved in America?
They have done.
So that's something to be optimistic about as well. But I just think it's kind of priced as if, all the Ozempic and Wegovy is just going to be a massive dud, and you're just going to get the insulin business, but it's not a terrible business to be left with. So yeah, I think it's got a lot of downside protection within the amount it's already fallen. So I think the question really is just how much of an allocation.
Yeah.
I don't know, would you want a single? I mean, we've not got much money to play with at the moment. We've got 80,000, so we've got 4 single positions, basically.
Yeah.
I think we could come back later and see if there's any money spare, but I think it has to be at least a full allocation of 20.
Yeah, I'd say a full allocation provisionally, but as we don't have huge amounts of money to play with, I think just keep it as that.
Okay, so that should give us 815 shares at about £24 each once we've converted from krona. Okay, what's next on your hit list then, John?
Baltic Classifieds, which I think was originally one of your picks, and
we've covered it a few times. Neither of us have ever bought it.
You'd liked for a long time.
Well, yeah, I think it might have been me that originally did it on the show, but that's just because it was a quiet week. Let's look at the draw.
But I think you have a good description of it. You would say it's the Auto Trader, Rightmove, Craigslist of the Baltic, basically.
And Indeed as well.
And Indeed. And it's listed on the FTSE 100. Or FTSE, it might be 250 actually, sorry.
I think it's 250. I think it's only about, just have a look, I think it's only about £1 billion market cap. Yes, 945 million market cap, so that will be FTSE 250.
Fine. And yeah, I think it's only been listed in London for a few years. It hasn't been around there for ages. But the numbers it's been putting up have been pretty impressive. It's got a monopoly on a lot of those markets. I think when we've discussed it on the show before, you don't know how much growth is left, given that it may be, saturated, but the addressable market size is a bit, or has always been a big question mark there. But it's not had a commanding valuation with the share price sort of coming back to earth over the last year. I think it looks attractive, and I would be willing to put a single allocation forward for it. It's not one that I own myself, but I am considering taking a position in it. Sam, what do you think about it as a single allocation?
Yeah, I agree. I think for the first time we've covered it, really, it's been a business we've liked. The issue's been the valuation, because it was at a PE of about 40. And for a business that was growing at maybe 20% a year, it was just quite steep, especially, like you say, we didn't know the saturation levels in the Baltic. I love the diversification of it. You are correct in terms of it listed in 2020, But I think it was very, very late 2020 because at the minute it doesn't have any 5-year performance. So I think it must have listed at kind of very back end, maybe start of 21. Over that period, though, it's kind of run up a lot. So it's actually got a year high of £3.98 and a year low of £1.68, and it's now at £2.1p. That P ratio is now 20p of 20. If you want a bit more detail, we did actually cover it last week. Yeah, I didn't think the figures were that bad. They'd obviously had a problem with a new tax in one of the countries for the vehicles, and that affected the auto business. But again, you go back to how well diversified it is, and if you look at some of the companies we've covered on the show, I mean, for example, we've got Rightmove on the list to discuss later. You've got the Rightmove of the Baltic, but you've also got all these other high quality businesses, and it kind of, it reminds me a bit of Money Supermarket actually in terms of how well diversified it is. Hopefully in terms of performance, it won't mimic it, but yeah, I think to get it at P of 20, I think very, very happy with a single allocation. And I think it's one that I'd be very keen to add to my own portfolio, actually. I discussed it last week, but the issue I've got is I might need to buy a house next year. But I don't know, now that I've been able to reflect on some of these other businesses in there, I think there might have some stuff I could free up for it. But yeah, I think it's got to be in there. I think we've liked it for years and we've not been able to get it below kind of 30s or 40s PE. So I think we should definitely take the chance now. It's at 20. So okay. I'd do single allocation of 20,000 then. I'd agree with that.
Okay. What else do we have on there?
Well, I don't know if it'd be nice to move on to Rightmove, actually.
Okay, well, I suppose
the Baltic version.
Yeah, fine. Rightmove then. So it's a business that, again, we both own. We historically have both really liked. It has had a bit of a turbulent 18 months. It's had a takeover offer which was rejected, and it's also then had some results out relatively recently, which we will need to cover on the show, whereby it's invested around £1 billion in AI technologies within the business. And this has been heavily criticised, and essentially the share price has reflected negative sentiment over that decision. I think we both like it partly because it essentially has a monopoly on UK estate agency, and it's got incredible margins, probably some of the best of any FTSE 100 company. Is it between 70-75%, Sam?
It's around 70, yeah. It might be pushing it. In fact, let's have a look. I'll check. So, it's dropped off. Oh, yeah, I'm looking at the wrong year. So 2024, it was 65.65% operating margin. However, for the 3 years prior to that, it was in the 70s.
Okay.
So usually around 70, which interestingly is where Baltic Classifieds Group is as well.
Fine. So it is right up there. And in terms of its current valuation, that certainly has come back down to earth. I mean, it was often, when we took our positions, we'll be trading in the high 20s. And now that's come back down to, is it around the 20 now, Sam, at the current share price?
19.66.
19.66. So I suppose the question is, do we think anything has fundamentally changed? Has the investment thesis changed? And do we top up on it?
So I don't think the investment thesis has changed. I think it's too soon to tell whether the billion in AI has been wasted or not. I'm using Rightmove quite a lot at the moment. I can't say I've noticed any new features or anything on the user end that would seem to justify £1 billion investment, especially for a company that's only got a market cap of, I think, about 5 billion.
Yeah.
4 billion now, thanks to that. But it churns out so much money that it would be annoying, and it would be a big waste of a lot of shareholder funds, but it would recover. And that's assuming it's a total write-off. On the flip side, though, it's already a position and a half. So we must have topped it up at some point already. So then I know we've not topped it up to the degree of a Diageo or a Disney, but if we're making that argument and we're looking at our performance and saying we maybe shouldn't have done that,
yes.
Does it fall into... And then as well, we are kind of getting a similar business in Baltic Classifieds at virtually the same PE as well, that I'd say is actually performing a lot better.
Yes.
And I know we've got money for both, but I just think when you take all that in the round, are we best just leaving it as it is? Because the other thing is, in my own portfolio, I own Rightmove, and I think you do as well. In terms of my behaviour in the next 12 months, I think I'd be much more likely to add Baltic Classifieds than I would to top up Rightmove.
Yeah, no, I would agree. Let's leave it as it is.
Right. So next up, we've got Taylor Wimpey.
Taylor Wimpey, I think at the current valuation and potentially where we are in the cycle, it is attractive. It's got a very decent dividend yield. And as we've continuously said on the show, you have a shortage of houses in Britain. And the way that that's presumably going to be addressed, or the only way that would seem realistic, would be through the big house builders, Taylor Wimpey being one of the biggest. I guess one of the things with Taylor Wimpey is whilst it has a very good dividend yield, we haven't seen planning restrictions significantly lifted or the system improved. So to actually crack on and build the houses is a lot more difficult. And that is really what's holding Taylor Wimpey and the big house builders back. Is anything going to change in the next year? Who knows? I put Taylor Wimpey on the list on the basis of valuation. I suppose looking at some of the other companies, which I would argue probably don't have barriers in their way to further growth and our allocation already to Taylor Wimpey, I'd be actually tempted probably just to leave it where it is. What are your thoughts, Sam?
I'd probably quite like to come back to Taylor Wimpey if we've got some at the end, because I think the thing is, with Taylor Wimpey, the yield at the minute is nearly 9%.
Yeah.
And we are losing a good amount of dividends by selling British American tobacco. So I actually think because the yield's that high, I'd be quite interested in maybe topping it up a bit. And I don't think it's one although in fact, actually, it must have been topped up already. It's got a 30 grand cost. Well, I'd maybe leave it if it's already got a cost of 30 grand.
Yeah.
Actually. I'd probably sooner top up Taylor Wimpey there than Rightmove, I think.
Okay.
I don't know, what do you think between the two?
I don't know. I take your argument in terms of Baltic Classifieds. I think Rightmove is the higher quality business. Taylor Wimpey, on the other hand, is very cyclical, and it does feel like you're at the bottom of a cycle. I suppose you could be at the bottom of a cycle for, potentially years. I know at the moment we're getting a decent dividend for that. Yeah, I think that's a difficult one.
I mean, they are both already a position and a half, is the thing.
Yeah. It is tricky. So we've got two positions essentially yet to allocate.
Yeah, unless we wanted to go back and have a discussion about trimming something else. But yeah, after two more positions, basically we've run out of money.
Okay, fine. I suppose one that I have wondered about is Coca-Cola HBC. It's not one that I own personally, and it is one that we've covered quite a few times on the show. We both like it. I think we agreed that since they acquired the African business, that has made it an even more attractive emerging markets play on Coca-Cola at what seems like a fairly reasonable valuation. So you've got that quality brand of Coca-Cola, which, as we know, with Daddy Coke in the States, is still does fantastically well. Probably one of the, if not the strongest brands that exists, but is largely saturated. And then what we have listed on the FTSE 100 is Coca-Cola HBC, which was essentially originally Greek, but it's the bottling and owns the rights to Coca-Cola in Central Eastern Europe and also quite a lot of Africa now. So I would wonder, do we, that growth story, do we invest a single allocation to that?
I find it really difficult with Coca-Cola HBC because I'm so anchored at the price when Russia invaded the Ukraine. We could have got it for about 60% off the current price if we'd had a bit more vision with it. I take your point with the Africa business. I mean, the current PE as well is below 20, which, again, I know I'm just repeating what you said, but I think for the quality of the business and the performance, it would have been nice to have got it 60% ago, but you can still argue for the valuation. Just kind of thing, in terms of the opportunity cost, are there better options out there? I think my flip side would be it's proven to be such a good business and one that we like so much. I think it needs some allocation, really. And I'd probably, especially with us running low on funds, what about a half allocation and hope that we can get it cheaper next year and top it up? I know it's a bit of a risk, but we kind of hedged our bets a bit, so maybe just do 10.
But on what basis do you think you'll be getting it cheaper next year?
Multiple compression.
Mm,
Okay, I take your point.
okay.
No, put it in there.
Okay.
We've had plenty of years where we've picked crap businesses at cheap prices.
Yes,
And we'll pay up for a good one for once and see if we can catch up the index. So we'll do 20,000 for HBC.
Great. Okay.
It's as well. It's I know it's not in any of our personal portfolios as well, but it's been a number of years we both really like this business and we just keep watching it
Absolutely. No,
increase and increase. So we're getting into next territory here in terms of all the money we could have made.
Yeah. No,
right. Next, should we do primary health properties?
Yes.
One of yours?
Absolutely. So it's one that I have bought over the past year. For anyone who doesn't know, and we've covered it a few times on the show, but it's essentially a REIT with a play on GP surgeries across the UK. There's been quite a lot of consolidation over the past few years. So Primary Health Properties has bought Medic X, which was a relatively small but still fairly significant GP surgery group. And then more significantly in the last year, it's merged with Assura, which was the other big player on the FTSE 250. One of the things that's quite attractive about it is that there seems to be an emphasis to have more care in the community and deliver more healthcare in the community as opposed to in big hospitals. GPs generally don't like to spend very much and to sort of build their own surgeries. Therefore, a group like Primary Health Properties Limited will come in, build a surgery, might cost a couple of million, and they will sign up the GPs to 25, 30-year lease, which is backed by the government. So they have incredibly high occupancy rates, virtually no defaults, and it's a very steady stream of income for the group. It's a company that I haven't been as interested in historically. And I think that was in the world of ultra low interest rates and these companies seemingly having quite high valuations for not delivering huge amounts of growth. I think fundamentally what has changed in the last few years is interest rates have gone up and the valuation of these businesses has come down a lot. And this does seem to be the emphasis from Westminster and West Streeting to continue the expansion in primary care. So, i.e. the fundamental driver behind growth in the industry, I think is still there, driven by essentially state investment. The appetite amongst GPs to build their own surgeries is very low. So again, I think that there's that fundamental there. And as the valuation of these businesses has come down a lot, you have seen the yield go really quite high. So Primary Health Properties, I must have bought in the last 6 months when the yield was about 8%. The share price has improved a bit since then. The yield has come down to 7.3%. I know it hasn't changed very much. To a degree, I think I was looking for that 8%, and I was very happy, when I got it. But I wonder whether that is something that we just have chugging in the background and producing, a decent, healthy yield, which I think over the next few years will probably grow as well. What your thoughts on that are, Sam? It's not one that I think is going to have shoot the lights out growth, but even if it just ticks away and pays a very decent dividend very securely, whether that's one that would appeal to you.
I think I'd be quite happy with it. Yeah, I think obviously I know a lot less about the industry than you do, but kind of everything you suggest about the way it's moving, the way sort of GPs want to operate, I think that opportunity is there for maybe, hopefully for them to expand the portfolio, maybe some decent capital growth. But if not, I think that 7% dividend, well covered, pretty healthy. We can just take that and then just reinvest it. So yeah, I'd be quite happy doing an allocation to PHP.
Fine.
So 20,000 again.
Yeah. In which case,
we're out of money.
we're out of money.
So I think we've still got a few companies to discuss.
Yeah.
But I think if we want to go ahead with one, it's a bit of a tougher argument now because something has to give.
Yeah.
Unless we take money off one of the 4 we've picked. But I don't see any reason to do that because I think they're all 4 good businesses. And they're all 4 businesses as well that we don't currently have any exposure to. So we're not talking about top-ups here, we're talking about reposition. So yeah, so I think realistically, if we're going to add anything else, we have to get the money from somewhere.
Yes.
So with that being said, we said we'd circle back around to it. Diageo, we covered it, I think, last week anyway. They've got 15 or whatever it is, $1 billion brands. I know it's already a 2.5 position, but they've got Drastic Dave at the helm.
Yeah.
And I think, if a year ago you could have told us that it would be Drastic Dave coming in, we'd have absolutely bitten your hand off.
Yeah.
I guess it's then, well, actually, although we're very happy about that, if we've already got a cost basis of 50 grand, we've already lost 43%, do we just hope that Drastic Dave can get our money back?
I think probably that is the more sensible thing.
Right, okay, so we'll take Diageo off the list to top up. So the next one that I wanted to discuss was Domino's UK. So we have covered it before. It's a business that since the last time we covered it, I've started building a position in my own portfolio. In terms of earnings, it's not, the earnings have kind of dropped off, but I think that is temporary. But it's got over a 40% share of the UK pizza market. I think UK takeaway pizza market, which when you think how many like independent shops are doing pizza and stuff is just unbelievable. That market share is growing. It's pretty saturated. I don't think there's any getting around that now. But they think there's a decent opportunity in Ireland. They have a minority stake in Domino's Poland. I'd probably not value that much anyway, based on how their previous European ventures went. It now has a dividend yield of 6.4%. And they've been pretty open about the fact that they are looking for a second brand to acquire. And I'd hope that if they're able to take that expertise and buy a second brand, it could do very well. And if not, they've got pretty healthy dividends, operating margins usually around the 20% mark. So I just thought it was worth throwing it in there, but I am aware it's one that you're not overly keen on. So
I suppose one of the things I would bring it back to is compared with what the 4 that we've sort of provisionally allocated, do you prefer it over any of those fundamentally?
I definitely don't prefer it over Novo Nordisk.
Yeah.
Maybe on valuation, I'd prefer it to Coca-Cola HBC, but I think Coca-Cola HBC has proven itself to be the better business. I definitely don't prefer it to Baltic Classifieds. Primary Health Properties, that's probably more yours than mine, but
yeah.
So I probably do prefer it to that, but it's with the caveat that I'm sort of, for Primary Health Properties, I'm quite happy to sort of lean on your industry knowledge.
Yeah.
I did think by the time we got down, it might not be very optimistic for it, but it is maybe not the most convincing argument, but it's at a 5-year low, down 47% over 5 years.
I think we've had a few businesses that have been at sort of 5-year lows. When
we can catch this falling knife, John. Yeah, forget about the others.
Yeah.
But, in that 5 years, the revenue's gone from 500 million to 660. Gross profits up from 236 to 318 million. And they've even got the operating profit margin up a little bit, a couple of percent. So it's a business that's gotten better. And they can take that expertise and use it on a second brand. But they've said if they can't find a brand that basically can buy out of cash profits, that they can then go and scale, they're just going to return the cash to shareholders.
Yeah.
I think you are kind of getting into Domino's isn't going anywhere. So I think you're in terms of, I think you've got a good amount of downside protection now. And worst case scenarios are to just keep returning cash to shareholders, and it's a very healthy yield. But if you're not that keen on it, I'm quite happy to just move on to another one. Well, we've only got one left though.
Okay, let's move on. Let's move on.
Okay, well, I'll try again next year if it's the same valuation. So, final company, Supreme. It's been a bit of a yo-yo on this one. So, if we look at the history of Supreme, which we did touch on earlier, so Supreme, that was originally added in 2022, end of 2022. It was then topped up a year later, and then the year after that, it was trimmed. So it's usually a company that gets some kind of feature. But since we've trimmed it, like we've said, I think they've made a couple of really good acquisitions. The share price is down 20%, nearly 20% since we trimmed it. I like the acquisitions. They've moved away from vaping. I think we've got a lot less of uncertainty in terms of the vaping ban, in terms of we now know what's coming in, and also a lot of what's come in hasn't really had any effect, it doesn't seem. But in any case, I think they're doing much better in terms of moving away from that vaping business anyway. And I just think it's now, we trimmed it, we cut it in half last year. Although with performance, it's now sat at a normal allocation. So it's cost basis of 14,770 and it's worth 21,450. I'd quite like to kind of top it back up, but we'd need to sell something.
Okay.
The alternative is we do have $3,000 left over. We could just throw that in there. And I know it's not going to move the needle.
I'm just having a look back through our list.
But I think this isn't, we're not topping up a poor performer here, really. It's not the same as throwing more money after Diageo. We're talking about topping up a company that the only reason it was cut down in the first place is because it was more of we'd done very well on it previously. And I think it is more attractive than it was a year ago, just because of the business performance and the legislative environment.
Yeah. Do we just put the three? I know it doesn't move the dial, but do we just put the $3,000 in? Do you think?
Yeah, I think there's no point trying to get clever to raise an extra sort of $6,000 if there's not anything else we want. So yeah, I think do that. That gives us an extra 3,192, which in fairness would take the position up to about 25,000. So it's still a decent allocation. So yes, I think that's probably everything in that case. Unless there's anything else you want to discuss.
I don't think so. I think they're the ones that over the last year have sort of stood out that we haven't got in there.
Just to summarise then, so in terms of the changes for next year, we're selling British American Tobacco, we're selling YouGov, we're selling Fiverr, and we're selling Etsy. And then in terms of the purchases, we're doing 20,000 purchases of Novo Nordisk, Baltic Classifieds Group, Coca-Cola HBC, Primary Health Properties, and we're also going to use our 3,000 leftover cash to top up Supreme.
I think so.
So I think, and just to confirm for everyone, we are currently lagging the market by 19% world index over 5 years. So that's the amount we have to overperform by next year to catch it up. So fingers crossed that these businesses can get us over the line.
We'll see.
Right, I think that's everything then for another year. I say for another year, we'll be back next week. But in terms of the fantasy portfolio, that'll be another year.
Thank you very much for listening, and we will see you again next week and also next year to review the fantasy portfolio.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.